and it's going to be reporting.
Okay.
Yeah. Is there anything else you need before I go?
I've done what I am.
Are you sure?
Yeah.
Okay. Just keep this close if you want to use it.
Okay.
And then it should be reporting now.
Okay.
So,
all right.
okay, are you sure?
That's great. I'm sure.
Okay, perfect. Thank
Thank
you.
you so
Have a good
much.
one.
Okay.
And then it looks like there's one more that wants to join.
Yeah. Oh, so I have to admit. Oh, what up? So I'm gonna just say admit all so that I don't be talking and admitting at the same time. Yeah.
It might ask you to do it again.
Okay.
FYI.
All right. I will watch
But
out.
that's why I put the notifications on.
Okay. Sweet.
Thank you.
Okay. But just make sure that these two are there. Hello, everyone. Can you hear me?
Yes, on and off, on and off.
I am on and off.
Mhm.
Okay. Okay, let me see. Why is it on and off? Everything is fine there. Hello, can you hear me now? Can you hear me now?
Yes,
Okay.
very
Awesome.
audible.
Yeah, you too. Very, very clear. Thank you so much. I see there are some people who are still joining, which is great. Thank you so much for taking this important step to be part of us, especially to take this important step. You'll realize that the process of home buying is one of the most important investments that you will ever do. Today, I don't have any presentation. I'm not presenting anything. You and I are going to talk. And I will request you that you talk back, like ask questions, engage. I want to make it as neutral and as informal as possible. As long as at the end of the day, we're going home knowing that we have made at least a step towards our home buying process. Is that okay?
Yes.
Sweet. So we are going to begin. The rest that are still coming, they will find us along the way. We are pressed with time, but let me admit those who are still coming. Admit all of them. Okay. All right. Another thing that I'm going to is feel free, since we are going to make it as homely as possible, is feel free to speak Swahili. I want to believe that so many of us here are probably Kenyans or can understand Swahili. Please, let's make it homely. Let's speak Swahili if you can, and so that we can understand each other. No one is left is going to be left out today. Okay, so I'm going to start by saying that one of the reasons why I felt it important that we talk today is the sense of belonging. As I told you that today I want to talk very openly is because I know what it means after being here for a couple of years. That sense of belonging is very, very important, to belong somewhere, to have people whom you can rely on, especially when you need some things to go. There are so many things that you want somebody whom you can ask, as opposed to just entering and Googling and, forms that we always enter every time. You want somebody to talk to. You want somebody to give you answers, somebody to answer your questions. I'm going to talk to you as my brothers and sisters today, which you really are. The reason as to why I'm saying that Kenyans in particular and other people of African descent have really been very, very supportive to my business. And if there's any way that I can give back or assist, I'm really, really willing to do that. Now, I want to say that the process of acquiring a property or acquiring a home, over the times I've noticed there are a certain pattern from people whom I sell houses to or whom I help in the process of buying a house. There's something that is similar in all of them, in that they are not people with a lot of money. They are not people who are very smart. They are not people who just got it all covered or got support. But I noticed a pattern of tenacity. I noticed a pattern of resilience. I noticed a pattern of not giving up. And it brought me to understand that it is very important when you are going to engage in the process of buying a house, especially us. And when I talk about us, I wasn't born here. I was born somewhere else. I was born in Kenya and so many places that I've been. Coming here, so many things are new. And so process of buying a house is not as natural as somebody was born here. That is the process, and their parents did it, their brothers did it, and so they're doing it. But with us, we first of all have to learn. So we need to put our mindset in buying, in the process of buying. For instance, so those people who have bought with me, and I've seen them, and they are like testimony to me. They are people who constantly ask questions. There are people who every time they were willing to know what is next, what can I do? They didn't take no for an answer. And therefore, if you're really planning to buy a house or get into real estate, be an investor or create wealth, because I'm not limited to just selling houses. I do a lot of wealth building. I do a lot of finance and all that stuff. So it's a package that we will talk about later. But today I wanted to include a certain mindset while you are going to buy a house, because it's not difficult, but there's just a lot of so many things that you need to learn that can easily discourage you in the process. And I don't want that. Now, I will be talking by answering questions, because as I told you, I have no presentation. I'll just be responding to questions. One of them being somebody's asking, is it better to buy a house or to rent? I will answer that by saying that I'm not here to make you feel bad that you are renting, because renting is part in our lives. And there are enormous benefits of renting. However, renting should not be your stopping place. It should be your starting place, and then you move on. In Kiswahili, I think it's just a translation. In my mother tongue, they say, where penye umeogea au kauki. Like if you take a shower here, you don't dry there. You get out of that place, you go to another place, and you dry up. So the same thing applies to the process of buying a house. You start by renting. Perfect. When you're renting, you don't have so many worries. It gives you a start. You are able to save during that time. You are able to study the market. But the most important thing is, do not get stuck in renting. Renting might be cheaper at the onset when you start, but in the long term, you miss out in the freedom and building wealth. And I would go ahead to say that when you rent, you are missing out on the control and the stability of wealth building. Rent goes up, but mortgage stays fixed. In other words, what I'm trying to say is that if you can rent, you probably can buy a house and pay mortgage. Both of them have to do with payment. But did you know that this country pays people to own houses, especially on taxes? I know there are a lot of things that are beneficial when you are buying a house. You save on. I mean, you are in control. You're building equity. You are also able to borrow against the house and all that. But the tax system has about 5, if not 6 advantages that they give you just for owning a house. I'm starting by telling you that owning a house has its own benefit, even if you don't do anything. Just own and sit down. There are interest rates. By the time you pay your mortgage, in the first few years, you'll be paying very high interest to the lender or to the bank that loans you that money. But did you know that when the tax time comes, the portion of the mortgage that you've been paying that goes to the interest, you can deduct that one out. You don't do that in rent. Number 2, paying taxes. The taxes that you pay to the county when time for filing your tax, you can deduct that one out. Some benefits that only people who rent will only be imagining of. They will get there. The next one is capital gains. So the capital gains is when you buy a house and it's your primary residence and it's time for you want to sell it, because that's another thing. In the United States, people don't get so much attached to the properties. Owning a property is also part of wealth building. At certain point, you can cash out and go and do something else or buy another. You can buy a big house, and then when you sell it, you make profit and you buy 2 houses. That still works. Then you rent one and then you stay in another one. But what I want to say that if you sell your house, the profit that you've made, and that profit includes your gain, as in the appreciation of the house, that money belongs to you, plus the profit belongs to you, and this government and the tax system does not tax the capital gains. That money is yours to keep. You don't share it with IRS. Things like insurance. There's mortgage insurance that you have to be paying every month. When tax time comes, you also deduct that. And last but not least, and this is very important because so many of us are into adult family homes. So in adult family homes, we have what is called a tax code, to mean that when you're owning a home, the taxman is going to pay you for your expenses that you incur in that house. For example, if I'm using a room, one of my room in my houses as my office, okay, then I can say that that office actually is renting from me, and the expenses that I use in that house, in that room as my office, I can deduct them as well during tax time. And this is where we also have a tax code for adult family homes. That's as to why the taxes for adult family homes are treated differently, is because of the same advantage. So I can talk more and more and more of what you of the advantages of owning a house. The truth is you need one, and the other truth is you deserve it. Now, somebody asking a question, I want to answer this question. Is saying, can I really buy a home in the United States? Or is just for the wealthy? Interesting. I think I've partly talked about this. The truth is you can buy a home. You don't have to be wealthy. Anyone can do that. The next question is, okay. Another reason as to why you can buy a home without being wealthy is because the programs are there for you to buy a home. There are programs established already to help people get housing. And I wanted to get this, to get housing. There's a way we're going to use it later on, but for now, we treat it as to get housing. And these programs will range, probably you have heard about FHA, which is Federal Housing Administration. Is a government backed loan that government gives money to the, it actually insures the banks so that the banks can give you money. Another one is conventional, to mean that the banks themselves come out to say, we also want to give you money to have you buy a home. And then the other one is VA, which is for veterans. If you're a veteran, there's a very, very beautiful programs for veterans. And then the last but not least is USDA. So all these programs can help you to buy a home. You don't need to be wealthy. You don't have to have a lot of money. These programs are there, but they have a process. I'll talk about that process today. Does anyone have any question up to that point? Okay.
Yes.
Okay, go ahead. Go ahead.
I think I did not understand what you said about taxes in the aim of making it more appealing for mortgage. And I've heard people saying about using, I think, a mortgage code for when you're doing your tax returns, especially when you are in business. If you're doing tax return and you're in business, there is a kind of a code or something that will, prepare you for having your accounts to be more attractive.
Okay.
Yeah.
Right. Very, very good question. So that one is under the topic where I say that there are tax advantages that you get when you own a home. So there are incentives that the government is giving you through the IRA so that you are able to, so that you can buy more houses, making it easy for you. And they are the following. Actually, these are the main, there are probably others. We have, when you pay interest, that interest that you pay back as part of your mortgage, you can deduct that. So you take it out as an expense when you are filing your taxes. Number two, there are taxes that you pay to the county. So those taxes, that is the house taxes. So every house you pay taxes on it. You will know when you buy a house, there are taxes that you pay. Those ones you can also deduct when you're filing your taxes. It's an incentive that homeowners are given. Another one is an insurance that the house has to be insured, and that is an expense. So as a homeowner, you'll be like, no, I spent on this house. So when you're filing, then you can deduct that as well. There are limitations, there are some requirements, but then you can deduct that. Another one, last but not least, that you are talking about is now if you are using a house for business. So if I'm using one of my rooms for business, and then I'm spending my time there, I can, for example, rent that room to myself. It is my house, but I rent that room to myself. And the expenses that I operate with in that house, in that room, being my office, I can deduct them when I'm filing. Now, the same applies to somebody who is doing adult family home in the house because it's a business. It's just that this time around, you're using the whole house, right? So there is a specific tax code. I might not go into details because I'm not specialized in taxes, but there's a tax code that is applied. And when it's applied, then it lowers your liability in the house. It lowers your taxes, and it's a tax code that helps you to reduce what you're supposed to pay eventually as a taxpayer in that way. So what you should just know from this is there's a tax code for you, so that when you are filing, please let your tax person know, your CPA know that you're using the house for adult family home. In that way, they'll be able to apply that code. I don't know how they apply it. It's something that CPAs know, but they do apply that. Did that answer your question?
Thank you.
Okay. All right. Let's move on. The next question, somebody's asking, is it better to buy? Okay, I think I've talked about better to buy or to rent. The next one is, do immigrants or self-employed buyers qualify for mortgages? Right. Now, the answer is yes. And there's a bit of limitation that was introduced early this year. Not early this year, but early last year around May. Anyone could own a house, and anyone can still own a house in the United States, whether you are an immigrant or not. And you don't need a green card. You don't have to be a citizen for you to own a house. All that you need is work authorization. So if you have a work authorization, which is basically work permit, you are able to buy a house. The only difference, what Trump did around May last year, he changed that only people who are citizens will be able to qualify for FHA. Now, what's different that makes? We have that FHA is a little bit more lenient in giving you loans, and now he says that, and it's FHA allows you to buy at 3.5%. Like your down payment will be 3.5. But then now that one has been scrapped off for people who are not citizens of the country. So where does that one leave you if you're not a citizen already? You can still use conventional, because the only big difference is conventional might be 5% instead of 3.5. So there's a 1.5% difference. That is the only difference. And you know what? Sometimes, since conventional loans are done by private companies and banks, they are now going down until 3. So you can still, you are not a citizen, but you can still get a loan that allows you to only pay down 3% without any problem. So is it a big deal? It's not a big deal at all, whether you are a citizen or not. You can still buy and still get better rates. Okay. Now the next question that I wanted to clear is self-employment and being employed. It is important that I make this very clear early in this session. The mortgage, the programs that we have, there's FHA, Federal Housing Administration, and conventional or VA, they are to help people get housing. Now, and if you are employed, from the perspective of the lenders and the government and the banks, there is that belief that you are trying to make life meet. So you get employed, and then they use your employer as your collateral, sort of, as somebody who backs you up to show that at least your money is going to come from somewhere. And therefore, it is easier to give somebody a loan using the self-employment. It's become easier because what we need then, we just need your, of course, your credit score to be okay, and your work history doesn't have to be long, or we might need 3 pay stubs or more, and there you go. You get qualified, and of course, your DTI, which is debt to income ratio. I'm going to talk about this a little bit later. But once all that is set up, is easy, we get you, give you a loan. And then there is another person. And this is somebody who is self-employed. So he comes and he wants to be given a house, and we will be asking, where is my income? And you say that, no, I'm doing business, and I'm in this industry, and I'm paying myself. So the moment you bring the self-employment, the ballgame changes. First of all, is because the government or the lenders or the banks, through these programs, will see you as an established person, as somebody who has got his money, somebody who has gotten it taken care of, and probably don't need to be helped. Number 2, they will say that we can't verify your income. And therefore, for us to know whether your business is making money or not, we will need your taxes. So for somebody who is employed and using W-2, we just need 3 months to see that, okay, he is employed. But if the ball game changes. The ball game changes completely, and you might not, it's not easy to qualify unless you have been in business for 2 years. Now, I wanted to make this very clear. Some of us rushed. I remember when I came, I was in business, and I said, like, okay, I have some money saved in, I want a house. And I was told, no, we can't give you a house. So just that it's easier for somebody to get a house when you are employed than when you are self-employed or when you are in business. Okay. That being said, the next thing will be, so if you are not employed, we'll need you to bring taxes for 2 years. That's the way to verify. So I would really, really advise people who want to start, don't rush to be in business. Don't rush to say that you want a house for adult family home. Just say that you want a house that you want to stay, then you can do business in it. But if you bring the element of business right in front, then the ballgame actually changes, and it might be very difficult for you to get a loan. Does it mean that you can't? No, you can, but they will request for about 20% or sometimes even 30%. That's a lot of money. Does somebody have any question up to that point?
Yes.
Go ahead.
Yeah. Is it possible to refinance with a different institution than the one that maybe has already approved a loan for a house?
Good question. What is refinancing? Refinancing is starting afresh on your loan.
Yeah.
For example, you bought a house, and during that time, and refinancing has to do with the rate. You want to cash out in difference in the rate. So if you buy a house now, the rates are 6%, and then maybe a 1 year or 6 months down the line, the rates go down, the rates are now 4, then you can cash out in difference of the rate of the rates, because the 2% in the rates can make a very big difference on what you pay, can make a very big difference in the value of the house. So what happens is when the interest rates go down, then you can go back to either your lender and tell them that you want to refinance and take out the money that is the difference between when you started, it was 6%, now it's 4%. So the difference in the value of the house, that is what you take out. Sorry, let me admit somebody here. Yeah, so if your lender who gave you the money initially does not give better rates at that particular point, you are free. And this is the work of refinancing. If you go to another bank and they're giving you a better rate than what you are paying at the moment, please go for that. And then you can cash out or you can increase your equity in that house. Did that explain your question?
Oh, yes. Linking another question to that answer. So is it possible for me to then use that certain difference from a better lender, like cash it out and then maybe use it to just improve the house and so on?
Not only use it to improve your house, you can go and fund your life. You can go for a vacation.
Okay.
It's a pull out, it belongs to you. And it is part of the advantages of owning a house. That house is not taxed. It's part of your capital gains. And capital gains for somebody who is not married, you can pull out up to 250,000 profit. If you make profit in your home up to 250,000, you can pull it out without being taxed. But if you are married, you can go all the way to $500,000. So if your house goes equity, which has a capital gain. Capital gain means the profit on it. You can pull out up to $500,000 without being taxed. So yes, you can take it out, do whatever you want, including renovating the house. Okay?
Okay, thank you.
Thank you. That was a good question. It's a good question. Right. So the next question that somebody is asking, what is the best time to buy? I always respond to this with another question. Actually, the right question that's supposed to be asking is, are you prepared? The reason as why I'm saying this is because there are advantages of buying at any time of the year or of the season, any time of the market. So we have, for example, that when the interest rates are high, people usually don't buy. The buyers are desperate. That is the time for you to negotiate. That is the time for you to get a better house, and you can negotiate it down. And then, did you know that when the interest rates are high, that is not a reason for you to shy away from the house. What you can do is buy now and then refinance after 2 years or after 6 months. It depends. Anytime the interest rates go down, you can buy, you can refinance. Another thing that you can buy down that interest rate, put $1,000, $2,000, reduce that interest rate by 1% or 2% by just increasing $1,000 or $2,000 when you're purchasing. Then the interest rates are going to go down for you for the next 1 year. And then when the interest rates are normal, then you can refinance again. So what I'm trying to say is there is no good time to buy. It's a matter of, are you ready? When you're ready, there are strategies to buy at any given point, whether it's the winter or in summer, in the high peak or in the lower peak. There are advantages of buying a house. Any question?
Yes. Are you saying refinancing when the interest rates are high is not a good idea?
Yes, you're right. Go ahead.
Yeah, I'm asking whether.
No, it's not a good idea.
Okay.
Refinancing is about lowering the interest rates. When the interest rates are low, it's taking advantage of the low interest rates. Now, for example, somebody who buys a house when the interest rates are 6 can refinance when the interest rates are 4 or 3. Okay? But somebody who buys a house when the interest rate is 3 have no reason to refinance when the interest rates are 6. That he will be losing money if you do that. Does that make sense?
Yes, it does. Yeah.
Yeah. Okay. That is a good question. That's a good question. So feel free chip in to ask questions as we go. Another person is asking, how do I know if I'm ready to buy? Okay, I said it's good for you to get prepared. Now the question comes, how do I know if I'm ready to buy? Now, for you to know that you're ready to buy is you need to have a stable income in the first place. And if you don't have a stable income, go to work, get some good job. Number 2, after getting that job, let that job be stable. Okay, because I'll be talking about what the lenders and the banks look at, and you realize that is not the qualification that you really have at that time. Your history is got more to do with that. So once you get a job or that pays you well, not any other job. I mean, you can't work 2 days or 3 days a week. I don't know how much they're paying you. Yes, if they're paying you a lot of money in 2 days, well and good. But if you know, I mean, generally, you probably need to get a good job that you're working 40 days a week. And then, is it 40 days a week or 40 days a month? And then if you're paid well, make sure that that job is stable. The next thing is for you to understand the credit and know what your credit is and know how credit works. This one of the items that really messes people up most of the time. And I'm really open. I've talked to so many people about this. I've helped people about this. And we're going to talk about details on how you improve your credit score and what it is, how it works, and how it can help you. The third thing that you need to do is you need to have a dream. And it's not enough for you to have a dream. You need to have a dream and have a plan. If you have these 3 in place or checked, you are probably in the right path for you to own a house. Remember, the readiness is not about perfection. It's just about clarity. Be clear on what you want to do, especially what you want to purchase. Because another thing is, it will be very important that you have clarity of what that house is supposed to do. When people come to me and they say they want to buy a house, the first thing that I ask them is, what do you want that house to do? Because what you want to do with that house, or the pain that you want to solve by buying this house. And when I mean pain, somebody just wants a roof to house his children. It's like, you know what, I've been renting for a long time. I need a roof over my family. That is a pain that needs a solution. Somebody is saying that, you know what, I want to buy a house because I need to move from where I am to another place. In that way, that person's pain is a little bit different. And then other people have pain of just knowing they just don't know what to do. They just need to buy another house because they don't know what to do with this house. They don't know the process and it's confusing for them. So that's another reason of buying a house. So you make sure that you know your pain. Other people are saying that I just need to start an adult family home. I need a business. That's another pain. So make sure that there's clarity of purpose when you want a house. So these things are going to help you to prepare yourself for the for buying. Somebody's asking a question. What's the price range for a duplex in Spokane? Good question. Duplex, for those who don't know, duplex is a house, two houses conjoined together, where somebody can live this side, somebody can live the other side, somebody can live upstairs, somebody can live downstairs. So duplex means two houses together. It will depend with the place and the location, but most of them are starting from about 450. For good ones, you find at around the high about 600. And if you get condos, sometimes they can go up to 7, 8. But most of the time, from 450, 400, you can find. You can find at 400. Thank you. That's a good question. All right. The next thing is how you prepare yourself is somebody saying, what if I have financial mistakes or gaps in my employment or recently moved to the US? How do lenders really evaluate me? Yeah, this is a very good question. Because we are people who have messed up before. I mean, stuff happens and life happens. And now you getting your life together and you want to buy a house and you're like, okay, what is it that the lenders are looking for? Now, lenders, and I mean good lenders, don't look for perfection. They look for patterns. So maybe you messed up before, you can clear up and create a pattern of your ability to pay, because lenders are just like insurance companies. The main question that they're asking is, will you be able to pay or to repay the loan? So this question or the answer becomes clearer after a certain period of time. So if you messed up, yes, it can mess up, but you can create a history from there and create a pattern, and then they can use that pattern in the last year or last 2 years. And it also depends on what you want the loan for. So if you want a very big loan, then your history, they will have to stretch it way back. But if you want to buy something that is not very expensive, then they want to check a very long history. For example, if you want to buy a house, your credit, the history of your credit score, it won't matter too much. You can have a history of 3 months or 4 months, you can buy a car. But if you, because with the car, they usually give you a range of about 5 years of repayment. That is the duration. But when you want to buy a house, it is 30 years. That's as to why they want your credit score also to stretch a little bit back, so that when they feed in the computer, at least it's able to tabulate and give them some leeway to work with. They give them a pattern that they are able to project with, whether you're able to repay the loan amount or not. Now, how much money do I really need to buy a house? You need 3 things, basically. But I'm going to add some more things that probably you need to know. One is you need a down payment. So saving is very important. I know we can come that, okay, we need a house, but it's still important that you take control of your finances. And when I talked about mindset at the beginning, is the mindset of taking control of your finances. Be able to know where every cent goes. Only then will you be able to organize yourself in such a way that that the lenders are able to trace and know that, no, this person is able to pay back and you can be given a loan. So you need to save some money. Most of the time, if you are going to use the programs, that is FHA or conventional, 3% to 3.5. And I tell people the money that you save is the money that saves you. Number 2 is closing costs. This is a cost that you will have to pay when you're buying a house. And then what is closing costs? By the way, I've done a lot of videos. You can check them on TikTok. Just do Christopher Odinde. You'll find me on TikTok. I have videos on closing costs and down payments and all the stuff. So closing costs is very confusing to a lot of people. Why? Because it is not part of your buying. It's not part of your purchase price. It is the money that you pay the lenders or you pay the banks for giving you the money. You can think of it as paperwork that they do. Right from the time that they start checking your papers, pulling out your credit report until they give you the loan and then you close on the house, you need to pay them a certain amount. Usually it's about 2% to 5%, depending on the terms of your loan. Another thing that you need to prepare, and these are not so much, is the inspection. It is important that you inspect the house, and the bank will require that you inspect the house. This money is not a lot. It's usually about 500 to 650. So there's amounts that you might need to come up with. Another money that you need to come up with is the appraisal. Appraisal is checking the value of the house. Okay, so let me rewind it a little bit. An inspector or inspection, we check the integrity of the house. Why? Because you can come to me and say, hey, I like that house, I want it. And I go and check and like, oh, that house really looks good. From the pictures, it looks good. I go there, it looks good. But there might be stuff behind the walls. There might be plumbing that is messy somewhere. There might be electricals that are messy somewhere. There might be, any other thing that is not working very well, the HVAC system. So the inspector comes in and check all that and gives you a report that you can use to know whether the house is worth buying for that price, or you can also come out of the contract. So that is what the money for inspection that you pay, about 500 to 650, depending on who is doing that. The next one is appraisal. Is the listing agent or the seller will put a price on the house. So let's say he puts the house is 450, then that was what the owner thinks the house is. So the banks want to know that is that the real price of the house. So somebody calls an appraiser, will come in and check the house, physically do the measurements, compare this house to the houses around. He will look at the neighborhood, and these are some of the things that you need to know when you're buying a house. Because if you just buy a house anywhere, your house will not be increasing, or will not be increasing in value, depending on where you bought it. And I tell people, don't buy the nicest house, don't buy a house where your house is the nicest, unless you're interested in the house being appreciating. Because if your house is the nicest and the person next to you is having a shark, the value of your house definitely comes down because of them. But I would advise that you buy a shack in upscale neighborhood. So buy a shack in South Hill, buy a shack in Beverly Hills. In that way, that shack will increase in value very fast. Now, that value is what is determined by the appraiser. So that amount is about 800 to 1,600, depending on where or who is doing that. So the last thing is have some reserves. Surprises are always there. And your lender also wants to know that you are able to handle surprises. So if they say come with 10,000 closing costs, please try and save at least 11,000 or 15,000, so that if anything comes along the way, you are able to tackle that. Any question up to that point? All right. Okay. Let's get to another question that is coming up. Your question?
Yeah, I have one question. So, what determines the closing cost? Is it the amount of loan or is it the value of the house?
That's a difficult question. Okay, but it's a nice house. Somebody is also asking another question. So let me start with the question, then I'll go to their question. Now, the closing costs, there are quite a bit of things that go in the closing costs. And as I say, that is paperwork. And this cost comes up because when you're buying a house, it's not only you and the seller and the realtors that are involved. There are other companies that are involved. There's title company, there's closing company, there's insurance company. All these are involved in the transaction. So at some point, you won't need to go to all these people, but there are people who are involved to do all that, and then all of them are being paid with the closing cost. And the lender usually pays them with the money that you pay them. So you are paying the money that goes to the court to register your house. You are paying what is called transaction coordinators, who are actually doing documentation and filing them and printing. You're paying those people. You're paying the escrow. The escrow are like mediators. They are neutral in between here because you don't want the buyer and the seller to having any kind of brushing shoulders. So they are neutral. They handle money. They help the transaction to move from one way to another. So all these companies, all these entities, all these people are paid with a closing cost. So closing costs will vary as to how much is paid. Sometimes if an insurance is high, so it can be high. So all these people, depending on how they charge, your closing costs can go high. But it's usually about 2%. It has never gone beyond 5% unless it is extraordinary. Did that answer your question?
Yes. Thank you.
Now, let me answer the other question that I see here. Do we have those with zero down in Spokane, and how does it affect the mortgage? Okay. So this question I have it somewhere. Actually, it is in my next thing that I want to handle. So I think Jackie, just hold on. Listen to the next thing that I'm going to talk about. Is going to answer that. Now, the question is there any other way I can qualify for zero down? The answer is yes. The answer is yes. Now, first of all, we have that the programs for buying the houses, that is the FHA or the conventional or the VA, which simply means veterans, it's a veterans assistance or something like that. It's assist people, servicemen, to be able to get houses. And then we also have USDA, which is the loan that is given for people who are buying houses in the rural. So VA loans, that is for veterans. I said that is one of the excellent loans. Of course, is given to servicemen. It's an incentive to them. So they give zero down. So that is one place. If you are a serviceman, be ready. I mean, you don't need to pay anything. Their program is zero down. They can pay if they want, but it's zero down. FHA also has a zero down. However, it is way, the standards are high. The entry point is a little bit high, to mean that you will need to have a credit score of about 700, not 700, but 780, almost 800. You need to have very good income, income that is able to allow you to pay your mortgage and still remain with about 80% of your money after paying your mortgage. So probably there's a little bit high amount. Another thing is debt to income ratio, which is how much do you owe versus your income. So they will look at that debt to income ratio. A nice debt, a good debt to income ratio is about 36. And most of the time they will allow you until 40. But for you to have zero down, your debt to income ratio has to be 36, which is most of the time very high. But can you get a zero down? Yes, you can. To mean that just be very, very good at what you're doing. Like your credit score, take it over there, get a good job, pay your debts and all that stuff. You can get zero down. Did that answer you, Jackie? Jackie, are you there? Okay. Anyway, if you understood what I was talking about, yes, you can get zero down. It's just that you need to the standard is high, but you can get it then FHA. There's zero down for first-time home buyers. Okay. The other myth that I wanted to get out is some people believe that you need to put down 20%. So that is not true. So don't be stuck and saying that I have to put down 20%. No, you can put down as low as 5 or something like that. But when do we have to put 20% down? This is when, for example, if you bought a house right now, and then 3 months down the line, you want to buy another one. If you go back to FHA and say that I want another house, they will say, no, we can't give you a house. Why? Remember, I started at the beginning by saying that these programs are to help people get housing, not people to do investments. So if you come 3 months down the line again and say, I want another house, they will say, okay, if you want another house, then we will ask you to put in 20% down. So that, doesn't mean that you can't buy a house, but they will consider you now you want to invest as opposed to the house to stay. Now I think I've talked about if I'm self-employed, so I won't repeat that. If you're self-employed, you'll need taxes up to 2 years to verify your income. Now I'm going to talk about the credit score. The question is, what is credit score? And why do I need the credit score to buy a home? I have a book that is coming up just on credit score, because credit score is not just because of you and me, but this economy is based on credit score. It's based on credit, and the credit score is like the meter that is used to measure. Now, we have that in this system. There's something that powers the economy of the United States. It is not just the hard work that determines how much or how best you do in this economy. It's not only the extra shifts that you do that is going to position you in United States. And so many of us, people of color, count of, I just want, if I can get a pay raise, or if I can just, get extra shifts, my life is going to be better. But most of the time, it turns out that we work ourselves out without, at the end of the day, obtaining what we dreamt that is going to be the American dream. Because the extra shifts, the extra money that we get, we can only do that much as human beings. And then when we come and want to use the cash, and we are told that we can't use the cash, we need credit, and our credit is not okay, we feel completely dejected. So it is not the extra shifts that you do in America that is going to secure your spot in the American dream. There is something that you will need to understand. It is the invisible engine that moves everything in the American economy. Think of American economy as a living organism or organism that is fueled by trust. The government or the financial institutions want to trust you. Why? Because this money, that is the American dollar, is no more pegged with gold. So it is just a piece of paper. Trust me. There's nothing that is attached to say that, no, if you have this, then you have these kilograms of gold or silver. It's a piece of paper. And that piece of paper is based on what is called trust. And when you are given money, and now we want to buy houses, we are asking for the biggest credit, because you are going to be given a credit of hundreds of thousands. You are asking for credit. You are asking to be trusted. And that is as to why credit score is very critical, that you know it, not only for you to buy a house, but also to make wealth. We have that when the lenders or even employers look at your credit report, they are not just looking at the numbers. They are measuring how trustworthy you are with opportunity. You know, in this system, trust actually becomes the currency. And credit score is the proof of the currency that we are having in the United States. Credit score is a living diary of what you do daily. It's a living diary of the promises that you keep by paying your debt timely, and the promises that you break when you don't pay. And all that is going through the records, through FICO, and it's stored there. And every time you come that you want credit, they will look at that. It's very easy to see that. What is the best credit score? So there's a lot that I can say on credit score, but that is just the overview of what credit score is and what it does. It is the measure of your trustworthiness. Now, the best credit score if you want to buy a house is 680. 720 is okay. If you have more, that is better. The next thing is credit score is not all about perfection. And understanding that when lenders look at your credit score, they are just evaluating the amount of risk that you are. And most of the time, bad credit score is not just to say that you're a bad person. And it's not a denial. So what they do, they use the credit score, as a determinant of what interest rate that you're being paid, that you'll be given. So sometimes what is going to happen that we have two people, one comes with a credit score of 740, the other one comes with a credit score of 550. It does not mean that we deny the person that has 550. So what you're going to do, if other things are okay, it's got a good income and his debt to income ratio is okay, is the credit score that is bad, what we're gonna do is give him, the person who's got 740 credit score, we're gonna give them a better rate. So we can give them 4. And then that is 4%. And the person who has a bad credit score, that is 520 or 550, is going to be given an interest rate of 7 or 9. Why? So as I said before, it does not mean that you're bad. It means that they are taking risk on you. So for them to be secure, they want you to pay a lot of money, and that is a lot of money. Trust me, in a mortgage, somebody who is paying an interest rate of 4% and another one is paying 9%, that difference could end up to be hundreds of thousands. And on the flip side, when you are refinancing, this is the same amount that you cash out. When your interest rates go down, you cash it out. But if your interest rates are, if you have a bad interest rate, like a high interest rate, and you're buying the same house for the same price, but you have been given a higher interest rate, you're going to be paying hundreds of thousands higher than the other person who you bought the same house with, but he was given a better interest rate. Somebody has a question up to that point. Okay. Now, how do I improve my credit score to be better? Like, how do I go through the whole process of getting credit and making credit work? The truth is, like, sincerely speaking, you don't need credit, and you don't need a credit score. If you have that mind of I don't need it, then you can use it as a tool. You know, what I've noticed as a financial advisor too that I am, is that people use credit as an extra money. If you are paid 4,000 and you are given a credit of an extra 1,000, that doesn't mean that you have 5,000, because that credit is actually dead. So let's not believe that we need credit for us to live. You still have to live within your means. You still have to live with the money that you earn. Now, the question comes, so how do I use credit and credit score as a tool? One, before you get into the rush of getting a credit score, if everything happens well, then I would go and get a credit score, a credit card before I need it. And if you are getting it, if possible, get the maximum if you can before you need it. Because banks are institutions that are very happy to give you money if you don't need it. The moment you come and they can see the desperation in your eyes that you need some credit, they'll be like, oh, we got a problem here. So the first thing, if you are not in a hurry and you are able to get credit somewhere and you want to you have a plan in the future to buy a house, get the maximum of credit card that you can get, but don't use it. Be the credit worthy at that point, but don't use it. You can just put the card aside, continue with your life, continue with your debit card, or you can use it strategically. That is number two, is get the credit card and use it strategically. Strategically means that you need to have a plan, a reason as to why you are using this credit. Because I started by saying that, honestly speaking, we don't need credit cards. You don't need credits for you to operate. In as much as this is a credit economy, yes, I accept. But if you want to take control of your finances, you don't need credit cards for life. We need it for number three. We need it for leverage. We need it to make wealth. We need it as an enabler. So the first thing is get the maximum that you can. And then when you get it, use it strategically. Like use it if you want to use it specifically to increase your credit. So just do that. Don't use credit because the credit card because you don't have money, you want to go and buy groceries. No. Use the credit card knowing that in the next 3 months or 4 months, I need to go and buy a house. I need to go and show my credit card. So what you're going to do is take that credit, go and max it out, knowing that the money is going to come from your account and pay that credit, and you move on in your life. So in that way, your credit builds, and once your credit is built, you are back to what you are doing. You are back to your life again. So if you can do that strategically, specifically to increase your credit, to do what you want to do. Don't use credit cards for life. Another thing that you can use the credit card for is use it for emergencies. Stuff happens, life happens. You can use credit card for emergencies to help you at that particular point. When you are done, please pay it back and go back to your life. I want to say something about credit leverage. So credit leverage is where you have credit, and thank God if you had a maximum credit, and then, for example, you see a house that is on sale for some reason, somebody dies, or somebody wants to sell the house very fast, or they want to sell something. It might not be a house, let's say a car, or something that you really need, and you don't have money at that point. So that is where leverage comes, where you can now use the credit, buy that thing because you need it now and you don't have money. Then when you get money, then you are able to pay. So in that way, you have leverage using your credit card. And we also do this with the HELOC, which is just, home line of equity with the banks. When you have a house, they create for you a credit. So this can help you to buy a house when there is an opportunity and you don't have money. So you can quickly grab what you want and get it without losing out. You leverage. Any question up to that point with the credit scores? Okay. If we don't have any question, I will go ahead. Somebody's saying, okay. So
I have a question, but not regarding the credit score, though.
All right, no, just go ahead. I will be able to chip in.
Let's say you have a house already, but from a different state, and then all of a sudden you move to another state, and you want to buy another house. How long do you have to qualify for another house in a program?
Thank you. That's a nice question. That's a very good question. Now, I will answer it in two phases. One, even if you don't move from one state to another, if you buy a house with FHA, they will usually require about 1 year to be able to buy the next one. Simply because the government does not want you to use FHA, these programs, as vehicles of investments. They want you to help people to get housing, like primary residence housing. So usually they want at least stay for 1 year. And then later on, what you can do, or sometimes there are provisions. And even when after that 1 year, there are some motivations that your lender can do for you. For example, you bought a house, you are yourself, not married, single guy, got some money, you are organized in your things and say, I want to buy a house. Great. And then you bought a house. 6 months down the line, you get married, right? Then in that way, if you get a good lender, they can motivate and say that you have upgraded. Now you have a wife, you need a bigger house. Another motivation is you have children now. Then the lender can motivate for you to get another house, sometimes before 1 year. But the baseline is usually 1 year. I think depending on the state, other states say 2 years, but most of the time is 1 year. So that is one. Number two, if you are moving, let's say you buy a house here and you're moving to another house, you're moving to another state, and you want to buy a house the other side. So that is another special thing. First of all, that you will have to prove is your work. So they will use your work to determine that you have changed location. And in that way, then your lender should be able to motivate that to the banks. And sometimes you can do 1038. There's an exchange program where you can get another house of the same value, and then instead of paying any taxes or paying any money, it's kind of exchange. You get this house and the other one is sold, and you can exchange that way. But otherwise, more than anything else, apart from 1 year, your lender should be able to motivate for you and say that you are changing states, you want another house, then that one can be sold, and then you buy the next one. Did that answer your question?
Yes, it did. Thank you.
Okay. All right, great. Somebody's asking, what is your advice of buying a foreclosure house? Now, for those people who don't know what a foreclosure is where somebody bought a house and for some reason they are not able to pay the mortgage. Maybe the person who was owning the house was a breadwinner, and then he passes on and the kids cannot pay the mortgage. So the banks come and takes the house and sells in a foreclosure. More or less, it's not an option, but you know what, the banks are taking it back. Now, foreclosure houses, one is most of the time you will not get an FHA or programs to buy the foreclosure houses. Why? Because there's no accountability in a foreclosure. The bank just wants their money. They don't want, because when you are buying a house, the process of buying a house, that is the last thing that I'm going to do before I leave, is there are things that you need to do. There is inspection. And then when a house is inspected and there are flaws in that house, then the buyer, the seller has the responsibility of doing what? Of making sure that the house is in good place before he sells it. When the price comes back, appraisal comes back that is not right, then the seller has to negotiate again, either take the price down. And so the banks are not willing to do all that. They are not willing to make any changes. As a result, the programs don't want to buy foreclosures. So most of the time, you will not easily get financing for a foreclosure, especially if you're a first-time buyer. So that most foreclosures are bought by investors. Did that answer your question? I hope so. If you have any question, Jackie, just type it in there. So yeah, so foreclosures, they are good. Sometimes you can find them cheap, but you might need to come with a lot of money out of pocket or use unconventional means of lending, like just go and get a personal loan or go to Shylocks or something like that. So, but the programs most of the time will not finance foreclosures. Okay, so finally, I know I've talked too much, but still, if you can jump in and ask a question, you can ask before we close. Now, I want to close by taking you through the process. So when you are buying a house, so in this case, your credit score is okay, you have come, and we have taken you through the process, and you are pre-approved, and you have a pre-approval letter. The next thing, we hit the road. We go and look for the house that you want, and then when we get the house, then we make an offer in the house. Now, when we make an offer in the house, basically is the price that is like, making an offer is like saying that you want a house, but it needs to be written down. So that's the first thing, that you make an offer. When you make an offer, you write it down, it goes to the seller, the seller looks at it and then responds and accepts it. Once they accept the offer, the one commitment, the first commitment that you're going to make is, it's called earnest money. Earnest money is some small amount, usually 1% of the purchase price. So if the purchase price is 500,000, you'll pay about 5,000. If it is 300,000, you'll pay 3,000 down, just to show commitments that you are not here to play. So that is the first payment that you're going to put in. The next payment that you're going to prepare is to, as time goes, then we're going to do inspection. And inspection goes with another thing that's called neighborhood review. To mean that at this time, between when you make an offer and the time that you do inspection, you have the responsibility of, as a buyer, to check the neighborhood, check if you like the place. If you don't like, you can come back and say that, you know what, I will check this neighborhood. I don't think it's what I thought it was. I want my money back. Now, the earnest money that you paid in is a contingency. Is the money that you either lose or get back. So you're supposed to, you get it back if you come out of the contract legally or with a good reason, and you can lose it if you just want to come out without a proper reason, of which I will explain. So, and we have a duration. So inspection. So if you do inspection and you realize the report comes back and you realize that you don't like the house, everything is leaking, and you're like, even if the seller repairs it, you think like, no, I didn't know that the walls are rotten. You didn't know that the roof was bad, because the inspector will give you a report on all that. Then you can decide to jump out of the transaction and you get your money back. Now, what if I just change my mind? Not like I don't like the house, and not like inspection. I didn't come out of inspection, but I just saw another house and then I say I want to come out of the contract. So most of the time, yes, you can come out of the contract, but you will lose your honest money. So the reasons for coming out of the contract might be genuine, so that the sellers don't see like you wasted their time. Now, as we move on in the process, you paid for inspection and the report comes back, you look at it. By the way, another way that you can do, you don't necessarily have to come out if the house has got a problem. Another thing is you can request the seller and tell the seller that they either reduce the price down because the house has got problems, or you can request that they fix the problems, okay? Fix any problems that were there as a result of the report, that inspection that was done. Another thing that you can request for is the seller credits. This is big. The seller credits is part of the closing costs. I remember somebody asked about closing costs, and I talked about the closing costs, and then the closing costs as costs that you just pay the lender or the bank for doing paperwork. So sometimes you can ask the seller to give you some credit, to mean that give you discount, and that discount is not added to you or given to you in cash. It can be given to you in credits, but if it's given to you in credits, then you can use that credit to pay your closing costs. Another way to bring down the closing costs, I don't know whether I need to get on it. It's a big thing, but I do have a lot of people with closing costs, so you don't have to worry about closing costs over and above the down payment. So what I will do when I'm making an offer for you, I actually request the seller right at the beginning to pay your closing costs. And sometimes this can be 10,000, 15,000, and that is really helpful, so that all that you do is just, just pay your down payment, only you don't have to pay the closing costs. So that's another thing that we'll talk about later. But always, if you are, I'm going to buy, you buy with me, or if you're buying with someone else, always ask for closing costs to be paid for you. Now, the next thing is appraisal. So you need to find if the inspection is passed well, then the lender will order an appraisal, and the appraiser come and looks at the house, and then there is another contingency. So when I talk about contingency, these are kind of covering, they kind of like armors for the buyer, because as a buyer, your money is at stake. Remember, the seller only has the house and the house is there, but you as a buyer, the moment you come, you pay that 5,000. So we have things that cover your 5,000. One of them is inspection, neighborhood contingency, and appraisal is also another cover. Another cover means that you can use these things and say, I'm getting out and I need your money. I need my money. So if the price comes back and it is not what the seller says, the price is too low, and the seller is saying that, no, I just want the price to be up there, I'm not going to take it down, you can decide to walk out. Or that is another time to come back again to the drawing board and negotiate with the seller and say that, no, seller, appraisal says that this house is only 350 and you are saying it's 400,000. I can't pay that. You either bring it down or we meet each other 50-50. So these are negotiation points for the buyer. When we get past that, you negotiate or you came out, but if all goes well and you move ahead, then you need to we will come back again and check if the seller did the changes that you requested, and then you probably just move into closing. I mean, we are just done. You move into closing. Remember, you have not paid the closing cost. Then we will go to the closing table, and that is when you pay your closing costs and you pay your down payment and you sign the papers, and boom, the house will be yours. After that, the lender is going to wire the money into the seller's account, and the rest of the thing, the closing or the escrow is going to record it in the codes. You don't have to know all that, but they will do that. People like us will get paid in there without even knowing how all that happened, and boom, you have your house. I've just summarized that. But if you have a question, you can ask. I can go into details of that. And generally, I think I am done. If you have a question, just I can tend to those questions before we close.
I think I have another question.
Go ahead, Mr. Samuel.
Let's say you have a house and you probably want to, okay, you probably want to sell that house to get another one.
Mm-hmm.
Is it advisable to sell it first, or is it advisable to buy another one before you sell the other one?
Okay. There are avenues that you can use, including 1030 exchange program, but it depends on how your capacity and your needs. Sometimes we do what is called contingent buying, where you have a house and you put it in the market. While it's still in the market waiting to be sold, you go and put an offer on another house contingent to selling of this house. So you can do that at the same time, depending on how pressed you are with money. So that is acceptable. You can do that. Another thing is it good to sell it first? Okay, another thing is probably you are talking in terms of how does it affect your ability to buy the next one. So if you are buying the next one and you're still owning this, your calculations on your ability to repay is still going to be appended on this. So when they're running your numbers, they will say that, oh, okay, you still have a debt. So whatever house that you are owning right now is going to be part of your debt that you're paying. So sometimes can reduce your ability to qualify for another house. So it actually depends on whether you are able to buy another house and still hold. You have enough money and enough credit that can be used to buy another house. But if you don't have, another thing that you can do is I think it's 1030, 1038, and it's an exchange program where you buy another house that has an exchange program that is the same. They look at the houses should be the same in terms of the number of rooms. It should be the same in terms of the neighborhood and the same approximately in value. Then in that way, you don't have to pay anything. The sellers can change. Like somebody can buy your house and then you get their house. No money, no taxes, no anything. So those are just avenues of how you can do that. But it all depends on your ability to buy the next one or whether you need this house to be contingent to the next one. Did that answer your question?
Yes, but does that exchange affect your debt to income ratio?
No. So that's why it's a facility. In that way, you just jumping from one to another.
Okay. Does this also account to the, like, if the value of the house is this much and the other value is that much, and then you have already kind of accrued equity on this other one, does that exclude the equity or is the equity included in it?
Right. So as I say that most of the time they will look at the houses that are very similar and also similar in value, the same value. And if there is any difference, then you need to come up with a difference in an exchange program. So let's say you are exchanging this for a bigger house with a higher value, then the value of this will be covered in part of that, and then you come up with the difference, and you will only pay taxes on the difference, not on the value that was the same as the previous one.
So what if the value of the one you're selling is higher than the one that you buy?
So the person who is coming to yours should give you credit.
Okay.
Yeah. And if you are the one who is buying a higher value, then you come up with a difference. You have to pay that.
Okay.
Sweet. That was a nice question. Is there anyone else with another question before we call it a day? And I want your feedback, guys. I need your feedback. I need your follow-up. There are some of you who actually made a registration in my website. I'm going to follow up with you and making sure that we engage you and we get you in a program, and then we follow up until you get your houses. Those who have not, please get in touch with me, and then I will help you to go through the process. I have lenders that are very active and willing to make plans as well. We Africans, we need plans at a certain point. Yes, so that is very important. And then also get into my Google and give me a review if you just like what we have just what we just talked about. Or if you have other questions that you want to ask later, just give me a shout at any time. My number is 360. How do I type it somewhere? I want to type it somewhere so that anyone can call me. I hope I'm not. Yeah. My number is, I want to be able to type here. Right. If you can take, my number is 360-712-9438. 360-712-9438. And if you don't get it, just go to christopherodinde.com. You will find me there, and in Facebook and in all other social media, and let's get in touch. Thank you so much for coming. Thanks for being part of this. Let's go ahead. Let's make an American dream happen. Thank you so much. If there's no any other question. Okay.
Thank you.
Appreciate you.
Thank you. Very thankful.
Okay.